I think one of the most important shifts that is underway, that is, I think, of the secular variety, not just pandemic related, not just short term, is I think we have exited the so called Great Moderation era. I think there is still validity in metrics like the inverted yield curve and the index of leading economic indicators, but this unique cycle has made us rethink some of what those messages are. Valuation is similar in the sense that it's a terrible short-term market timing tool. Different versions of phrases about the market and uncertainty often make me chuckle. The most common is the market hates uncertainty. And I always think, is there ever a certain period of time? Many investors have, maybe artificially or for whatever reason, have the S&P as their benchmark on the upside. But how quickly does a positive return become the benchmark on the downside? When there's more weakness in the market or it's a volatile week. Okay, Liz Ann, what are you telling your Schwab investors? Are you telling them to get in or get out? And I have a love-hate relationship with that question. I hate it because I think it's a stupid question.
So, Matt, we've got 20 minutes of clips, and we're going to talk about our biggest lessons from our interview with Liz Ann Sonders.
Fantastic. Liz Ann's a remarkable brain. She's one of those, have you been following her like I have on Twitter seemingly forever?
Yeah, she has some amazing charts she puts out. It's really good stuff.
And so grounding, like she's one of those people you have to follow just so you can get a glimpse at what the daily process looks like, because she shares a lot of these charts on the regular. So if you follow her stuff publicly in any place, LinkedIn, Twitter, wherever, you'll see some of the same charts show up. But then you start to see the way that these progress over time. You get a real feel for how she thinks about it. I think her work is incredibly useful, both in what I do with clients and also just talking about this stuff, because she keeps anchoring you back to stuff that actually matters and helps you frame up how to think about it. Really admire that.
And just a disclaimer before we start, this interview took place in January. So, and I think it's fair to say maybe some things have happened since January. Is that a fair way to put it?
Has anything happened since January?
I don't know. It just seems like there's a couple things happening on a day-to-day basis in the market right now. But what we did is we pulled out, we try when we do these interviews to make it as timeless as possible and not to focus on what's going on right now. And so what we've done is we've pulled out the timeless things that we think are the biggest lessons investors can take from that. And we're going to focus on that rather than what her take was in terms of what was going on in January.
And it's still useful because, right back to the idea we were just talking about the charts, because she can take stuff on a very timely level and then zoom you out and feed you frameworks to understand the world around you. You can still go back and listen to that January interview and take that snapshot in time and see how she's processing this. And I love that we're pulling these clips out because, again, she is a machine for just dropping these frameworks of like, here's how I think about the consumer. Here's how I think about valuations. Here's how this changes with historical context. These clips scratch the surface on all that wisdom.
So let's get this party started. We've got our first clip, and this is great because we were in a world for a long time where inflation wasn't an issue. Now we're in a world where it is. She has a great term for this she uses. So here's her talking about why the Great Moderation is over.
I think there were unique drivers to that bout of inflation, and that's why we often talk about, maybe more importantly, the differences between this era of inflation and, say, the 1970s era of inflation. Very different drivers. And in this case, although there's some longevity, obviously, to the inflation problem, at the outset, it was driven by the pandemic and severe supply disruptions. It's very different than the backdrop that existed in the 1970s. That said, I think one of the most important shifts that is underway, that is, I think, of the secular variety, not just pandemic related, not just short term, is I think we have exited the so-called Great Moderation era. So the Great Moderation period, and I'm not sure who initially coined that term. I've heard people credit Ben Bernanke. I've heard people credit Larry Summers. Maybe it doesn't matter who came up with it, but it's now the label that is regularly applied to the period from, people will start it at different points, but let's call it mid to late 1990s through to the beginning of the pandemic. And it was an era, to your point, of basically disinflation most of the time, save for a bit of a spike in some measures of inflation in 2008. But essentially disinflation and or low inflation, generally benign interest rate backdrop as a result of that. And maybe most important for investors, it was an era where nearly the entire time bond yields and stock prices moved in the same direction. Because in that low inflation era, when bond yields, as an example, were going up, it was typically because growth was improving without the attendant inflation problem. That's great for the equity market. Vice versa, when yields were going down, it was often because growth was weakening, moving into a recession, not because inflation was coming down, negative for the equity market. I think we're now have already transitioned into an environment that looks a bit more like the 30 years that preceded the Great Moderation. So the period from the mid to late 60s to the mid to late 90s, which I've been calling the Temperamental Era. I'm neither Ben Bernanke nor Larry Summers, so I don't know whether it's going to take off as a label, but I'm going to keep using it for whatever it's worth. And that was a period of greater inflation volatility. That's not the same thing as saying inflation was high and it stayed high for 30 years, but bigger swings in inflation up and down. There was also more economic volatility, bigger swings both on the upside and the downside, shorter cycles, ergo more frequent recessions. You had more geopolitical instability, you had more volatility in commodity markets. I think that is more akin to the backdrop we're in right now.
I think this is a good way to look at this because so many people have takes on what's going to happen with inflation. It's going to be really high or it's going to be really low. And I think what she's saying here is really important, which is it's going to be, I think she called it the temperamental era. It's going to be more volatile. She's not making her call about, 5% inflation or something like that. She's saying it's going to be more volatile. And I think for people like us who build portfolios, that's the important thing to consider here is we could have gone through our careers with basically the variable of growth being the only variable we cared about. And now when we're building portfolios, this variable inflation has to be considered because it's actually changing and it didn't change for a really long time.
From the mid to late 90s until a few years ago, the Great Moderation is basically, and the key insight here is, especially for portfolio construction, stocks and bond yields, not bond prices, bond yields moved in the same direction. And that gave us the correlation, that gave us great returns for the 60-40, that handed us a bunch of stuff that was not unique to that period of time, but we should recognize that was like the era that we were in. Now, the temperamental era, I like her framing a little bit better than the Great Immoderation. I've been struggling with this too. What can we possibly name this? But saying that this looks a lot more like the late 60s to the late 90s period, that chunk of time, when you shouldn't expect stock prices and bond yields to move in the same direction. You should expect more stuff to happen. And this idea of if the Great Moderation was really a period of kind of peak globalization, this era that we're coming into now, kind of like the 60s into the 90s, probably looks like, just like that was globalization coming together post World War II, that probably rhymes a little bit with globalization falling apart. This works for me on lots of different levels. Does it hit you like that too, where you can see how this plays out?
Yeah. And I think the one thing I think it's people have to keep in mind with this is, like, I put this on the YouTube cover when we did the original interview with her. I think I had the Great Moderation is over in there.
Yeah.
And people take that to believe like she's saying inflation is going to be raging.
Right.
And that's what you said is so important because this is a nuanced thing now. It's going to be variable. That's what she's talking about. And it's not the Great Moderation is over, so we're going to have this crazy inflation forever. It's that, like, going back to what I said at the beginning, we have to consider it. We have to think about it. When you and I build portfolios, it's a factor that has to be considered.
I love putting it that way. A factor that has to be considered, meaning we have to look for some historical context. We have to look over time and we have to think about it because, again, we're talking about the mid to late 90s until, call it like 2020 or basically around the pandemic as this period. We're literally talking about like a 20 to 30 year window. And then looking at the 20 or 30 window behind that when a ton of stuff happens, including some really great market returns that contribute to those long-term averages in the right direction. It's just, there's a big piece of time in front of us. We want to think and extend our time horizons to digest, and unpacking those factors, whatever they may be, really, really useful reminder.
So another thing people have talked about a lot recently is we've had a lot less recessions, in the most recent decades than we've had long term. And so here's her talking about that idea.
I don't think recessions are over, although, maybe we have to think a little bit more broadly about recession. So we obviously have avoided a formally declared NBER dated recession since the very, very brief COVID-related recession in 2020. However, we have had recessionary pockets. So if you think about how this cycle from the start of the pandemic to now has unfolded in so many unique ways relative to your typical cycle, not that we want to rehash the last 4.5 years, but bear with me for a minute. If you go back to the early part of the pandemic, when essentially everything was locked down, then we got the stimulus. That caused a huge surge in the economy, but solely concentrated in the goods side of the economy. And that was initially fueled by the stimulus dollars too, because services were shut down. That also became the breeding ground of the inflation problem with which we're still dealing. So you had sort of this surge in growth on the goods side, a surge in inflation on the goods within the goods categories of inflation. Then ultimately, when we had the reopening, we had the pent down demand on the goods side, pent up demand on the services side. That resulted in actual recessions in manufacturing, in housing, some of those areas that were early beneficiaries during the lockdown phase. We went from hyperinflation to disinflation to deflation in those goods categories. We just had the later offsetting strength on the services side of the economy. It's a larger employer, kept the labor market afloat, and its inflation components have been stickier on the high side. So I still don't think we've outlawed traditional NBER declared recessions, but it's also not quite accurate to say there's been nothing to see here. We've had nothing resembling a recession. We've just had it in pockets. We've just had the offsets. And I think that could continue. I think there is a scenario whereby if and when services maybe has its day in the clouds and falters, and you see it on the employment side too, it might be the case, particularly if that means the Fed goes back into easing mode, that we actually start to see recovery and growth in those areas that have already had their individual recessions. Therefore, the roll-through continues. So that we may continue in that component of this unique cycle. I think there is still validity in metrics like the inverted yield curve and the index of leading economic indicators, but this unique cycle has made us rethink some of what those messages are. And in addition, maybe the time gap between triggers, for lack of a better word, on some of those metrics and, the long and variable lags between that and impact on the economy. So I think we know this cycle is quite unique, and I think we'll go back to cycles that maybe are a little less unique and a little more normal. But I think the mindset that this unique cycle brought in is that there are differences in every cycle. And I also think this cycle unleashed a different thinking in terms of inventories and just in time to just in case. So I think there are structural changes to the economy and how businesses go about running their day-to-day lives that have changed probably forever. By virtue of the pandemic.
This is really interesting for me on a lot of levels. One is that really when you think about it, and I remember back to your original Clip Beta episode with Dave and Jason, you talked about this. We probably have had recessions in the post-2020 period. We've just had them in very specific areas. And so although we never declared a recession, she talks about goods versus services, and that's really important to keep in mind because it's easy to say, well, there's been no recession because NBER or whatever didn't declare a recession, but there's been pain in different areas, and it's kind of been rotating. Like we've seen sort of these rotating recessions behind the scenes, even though the overall numbers never broke down.
I like to declare recessions in my own life. I think this is a positive and a healthy thing. I want to be my own NBER. I want to declare a recession in, I want to go to the grocery store, look at the price of eggs and say, I am having a recession. Like I can't afford these goods. Or this is ridiculous.
You're having stagflation with the eggs, right?
Yeah. It feels really good to declare your own recession. I really suggest you try this. Really empowering to just be able to declare it as your own board. But to that point, stuff speeds up and slows down in pockets all the time. When we're talking about recessions, especially for markets people, we worry about recessions because we worry about protracted downturns where buying the dip doesn't work, where the markets don't bounce back, where things we might need money for can't come for certain places because now we want to be patient. Understanding that those are happening around us all of the time means there's opportunities for the rebound happening all the time. And once in a while, they're all going to happen at once. And it's a real mistake to try to think about we might just have a period of extended lots of little recessions in different pockets. That doesn't mean we have one giant globally coordinated one that tanks markets for 5 years. Doesn't mean that can't happen. Just means that's even harder to exist or predict.
And I don't think as investors, I don't know if we really should care whether inflation, like when recessions are actually declared. Because one, we've got this point we're talking about here, which is there's recessions going on beneath the surface when there's not an overall one declared. But the other thing is, we know that once a recession is declared, it's always been going on for a long time. So I don't know that there's anything like inside of an investment strategy. Everybody's been so worried since 2020 about, are we having a recession? Are we going to get a recession? And I don't know that it matters too much in terms of, obviously, if we do have a recession, the consequences in the economy are really important to everybody. But I don't know about like when the recession is declared or if it's declared really matters in terms of building anyone's portfolio.
Totally agree with that. I think back to, I don't know the years off the top of my head. You can correct me if you remember them. It was like a 3-year window in like the mid 2010s, maybe earlier to mid, the earnings recession. Just ring a bell to you? Remember the earnings recession?
Oh yeah, I remember the earnings recession.
Good times. But this was one of the first times in my professional career that I became really uniquely aware of looking for recessions, again, speed ups and slow downs in different pockets of the economy or things you actually care about. The earnings recession was a weird period because we talk about most people should not care about the labeling of this stuff. It's not worth the stress of wondering about the label. What you should care about, though, is what's speeding up and what's slowing down and stuff you're exposed to. So if you're an equity investor and you think like earnings going up over the long term is a really valuable thing, the earnings recession was one of those things where we went, earnings look like they're going to flatline and peter off sideways for a while. But the real question is, are they going to go down? Are we actually going to see these drop off? And in that period, one of my biggest takeaways was when we started to feel more confident that earnings weren't going to slump and actually go into a big drop off, kind of like what we saw at the financial crisis, which is what a lot of people were worried about. It was, all right, at some point then we're pulling out of this thing. The valuation multiples are all compressing. The earnings are holding up pretty well. The stock prices just aren't respecting that there's growth in a bunch of these areas. This is a huge opportunity. If you can start flipping it where you're not worried about the indicator and the formal labeling, and you're more worried about what opportunities is this creating for me and where, that's a way more empowering tool in my book.
Yeah, to her point in the end on the indicators, like people love these indicators. They love the yield curve inversion or whatever it is, but I don't know how useful they were in the first place because the yield curve inversion was, I don't know what the exact numbers are, but it's like between 9 and 36 months or something, we're going to get a recession after the yield curve inverts. Like, what am I doing with that? Like, there's nothing for me to do with that. And they didn't work this time, but I just think it's important. People love the indicators. They love the stuff, like the red flags and stuff. But again, it doesn't really matter in the scheme of things. And as she said, we may have to rethink the timing of these indicators because of the way the economy works now. The timing in terms of when they work might be different than what it was in the past.
I kind of want my own yield curve indicator too. What do you think? How can I make my own yield curve indicator? Is it like the 0% credit card offers come in and they change the duration on them? How can I build a personal yield curve indicator for my own personal recessions? What would I look at?
Yeah, well, I mean, you could just use something personal like that, or, I could just data mine the crap out of economic data and I could just give you one that works that'll never work again.
Awesome.
That's also a possibility.
Yeah. How many Nick Cage movies I watched?
We'll call it the Matt indicator. I don't know what it'll be, but whatever it is, we'll just throw it out there.
It'll probably be Nicolas Cage movies correlated with something else.
Nicolas Cage movie. Yeah. Well, actually, with the new AI and everything, we do have the ability to bring that data in now. So we probably could look at it against Nicolas Cage movies, and we could see what happens.
Daddy Longlegs, look out now. What do we got next?
So anyway, our next clip is another thing. This is kind of a pet peeve of mine because people love doing this, but here's Liz Ann talking about valuation as a timing indicator.
Well, I've always said, I already made the comment earlier in our conversation about sentiment. Even though it can be a pretty valuable contrarian indicator at extremes, particularly in optimistic extremes, it can stay there for quite a while. So therefore, it's not a great market timing tool by any means. Even as a backdrop at extremes, it might reference as a contrarian indicator. Valuation is similar in the sense that it's a terrible short-term market timing tool. One of the charts that I had in our 2025 outlook was your classic scattergram. And on the horizontal axis, I believe it was the horizontal axis that showed starting point PE ratios, just forward PE over time. And then on the vertical axis, it was S&P returns in the subsequent 1 year. And there was no correlation. I mean, the trend line was almost flat. The dots were all over the page, which suggests that valuation is almost like a sentiment indicator, or maybe reverse the wording, an indicator of sentiment. As we know, we lived it in the late 1990s, valuations can get rich and then ridiculous, and then absurd. But that can last for an extended period of time, and you never know what the trigger or the catalyst is going to be for what we know is the inevitable bear market that unfolds when you have a combination of really frothy sentiment and rich multiples. But trying to pinpoint the timing associated with that, I think, is a fool's errand and a very difficult task. And it works in the same direction, maybe to a slightly narrower time frame degree, when you get extremes of pessimism and you get to extreme lows in valuation. That can also persist, but the persistence tends to be a bit more short-lived than what you see at the opposite end when you have frothy sentiment and rich multiples.
And she's got a great scatter plot with this, but I hate this because people do this all the time. Everybody wants to look at stocks are expensive, so I should sell stocks. And like, it just never, ever works. Like, they always stay expensive way longer than you think. Like, if you think about the long-term averages, I mean, we've been above the long-term averages for decades now on stocks. So like, what am I going to do with this? There's basically no signal in any, 3 years, 1 year, even 5 years. There's not much signal in it. Like, when you start looking at it 7 years plus, we research affiliates and people have some tools. You can get some data about like thinking about expected returns in your portfolio, but people use valuation in so many ways that it just does not have any value.
Coming from a quant value guy, I can only follow that up with this. I'm in a sentimental mood. I can see the stars come through my room while your loving attitude is like a flame that lights the gloom. Are you familiar with this? Does this ring a bell at all to you? Do you know these lyrics?
I'm sure it should. It should. And when you tell me what it is, I'm going to be like, it obviously has to, but
it's the Duke Ellington classic, In a Sentimental Mood. Now, from this great era of post-big band to small band swing in the 40s into the 50s and everything else, you know what the key part about that sentimental mood was? The near constant, besides people trying to have a good time? Take a guess at what cultural thing was having a massive impact on poor Billy and Ella and everybody performing these songs. What's the common denominator?
I have no idea. You're going to have to tell me.
Heroin.
And I would have never guessed heroin.
Look, valuation tools, kind of like heroin and great music. Like, it's just there. It's in the background. There's some really sad stuff if you get too hung up on it, but you don't want to get strung out on valuation. It's a great sentimental tool. I love the way that she frames it like that. So instead of looking at this and going, oh, we're 2 standard deviations above the long-term CAPE or whatever else. Yes, that is indicative of the times. There's all this great stuff happening. Let's not ignore that and be too overly focused on the heroin, but stay off the heroin, kids. Take that from Billy.
So you're not going to get heroin and valuation on any other podcast here.
No.
So, yeah, I don't know if that's good or bad actually, but you're not going to get it. So anyway, carrying forward on this next one is a little bit painful for me, but here's Liz Ann talking about breadth.
Breadth has been also all over the map. We've had periods, particularly when equal weight was doing well and small caps were performing better. The breadth statistics started to look really good. New highs versus new lows, percentage of stocks trading above 50-day moving averages or 200-day moving averages. But maybe a little bit more unique way of looking at market breadth is one. It's a table that shows up on my X and LinkedIn feeds almost on a daily basis, which is what percentage of the index, in this case the S&P 500, has outperformed the index itself. So what percentage of constituents have outperformed the index itself over, trailing periods, over the trailing 1-year period, over the trailing 6-month period, 5 months, and down to shorter term periods. And for calendar year 2024, only 19% of the stocks within the S&P outperformed the index itself. The highest reading on a trailing basis was the final 4 months of 2024, where 40% of S&P stocks outperformed the index. But that's still obviously sub 50%. And by the way, we're only, a week and a half or so into the start of the year. But that 19% for the calendar year 2024, if you do trailing 1 year, that's down to 17%. So on that metric, we're unfortunately, at least at the early start of this year, we're not moving in the right direction.
And how rare is that for it to get that way?
Well,
that 19
last year, I don't remember exactly when. I believe, don't quote me on this, although this is airing out there, so anybody can quote me on this, but I'm telling you.
Snip this part right here.
I'm purely guessing based on faint memory, sometime mid-ish year. Might have been in May, might have been in June, because we track it on a day-to-day basis. that trailing 1 year percentage dropped down to, it was either 10 or 11%. I think that was the low, and I'm pretty sure it was an all-time low based on how far back we can gather that type of data. I can't say for sure that it's an all-time low in the history of, back to 1928 in the S&P 500, but certainly an historic low. And from there, it has, started to improve, but not to the degree that you would suggest that, the soldiers have come to the front lines along with the generals.
So that chart about the percentage of positions, percentage of constituents outperform the index just hits home, Matt, because obviously I'm a value guy, I'm a quant guy. Like when you're a quant guy, no matter how you build your portfolios, because very few of us are market cap weighting our portfolios. So if the average stock is underperforming the index, like it's very, very hard to come up with too much stuff that works in a world like that. So it's certainly a painful thing, but it's what we've been living through. We've been living through this period, and it's still happening this year, even after, we recorded with her, like a good percentage of the constituents within the index are underperforming the index itself.
This is part of why stock picking is so hard. This is also back to what we were talking about in the intro to the episode. This is why you follow Liz Ann's work, because she'll show you stuff like this on the regular if you just follow her on the socials. The surge that we saw at the back end of last year when the market breadth widened out, like that was a really profound observation, because we spent all of 2024 talking about Mag 7 this, Mag 7 that. And then all of a sudden, the last quarter of the year or last couple of months, we saw this broadening and it shows up in a graphic like this, where all of a sudden some of those things that weren't participating started participating and we could actually measure it. Do you know, I'm blank on this. What was the quote about like the market generals and like how you follow how good breadth is?
Yeah, the soldiers and the generals. I don't remember the exact quote on it.
Call your favorite 70-year-old broker. He'll correct you on the quote. Mine is halitosis. Make a good joke about bad breadth. But this is really important to watch. If only a few companies are steering everything like inside of the economy, you probably don't have a good market. And it probably really sucks if you're an active investor not concentrated on those strategies. Hey, and the great, like last time value really woke up though, there had to be a narrow window where you felt really great about, you had the 20 stocks that were working.
That's been the challenge. I mean, there was a long period, in 2020 where it did, but we've had so many of these false broadenings or whatever you want to call them, where it's like, it's broadening out like at the end of last year and then it's not broadening out. And then like, it's broadening again. It's like, it's not broadening. So, I mean, eventually we're going to have a period. This is the nature of value investing if you go back to the late 90s, it's the same thing. I mean, an extended period where it didn't work, and then it working really, really well in a really, really short period. And that's why it makes these types of strategies are really hard for investors to stick with, because it's very hard to sit. Like Cliff Asness talked about this when we had him on. He was talking about how duration of pain is worse than magnitude of pain. And so it's very hard for people to sit through these periods where only the biggest stocks are winning, to know that you're going to get this short period where the big stocks are going to lose and everything else is going to catch up. It's just a challenging thing to do. I mean, it doesn't make you not believe that the strategy works long term. It's just it's part of the strategy you have to accept if you're going to follow it.
And a huge reminder on your rebalancing strategy with this stuff too, right? Like if you know you're going to have long periods of pain, that means in your good periods, you better understand how you're going to rebalance to survive the next long period of pain. Easier to say than it is to do.
So this next clip, it always seems like anybody in the market, or if you listen to the news, it's always like we have an above average level of uncertainty. So here's Liz Ann talking about that.
The different versions of phrases about the market and uncertainty often make me chuckle. The most common is the market hates uncertainty. And I always think, is there ever a certain period of time? And also, the most dangerous words are, it's different this time. Really? It's always different this time. There are always different drivers of the economy and the market. There is always uncertainty. I don't know that there's ever one era that has it in spades more than others. There's just different kinds of uncertainty. So I don't generally balk at that notion. I will say when you have sort of extreme eras of worry, I think that there is, even though I don't like market hates uncertainty line. I already said why I didn't like that. I don't like the it's different this time, or why people criticize that. But, the market likes to climb a wall of worry. I think that there is credibility to that statement. I think that background, that backdrop of sentiment I think is important. It's not a market timing tool by any means, but it can serve as a catalyst in both directions.
So Matt, before we get into the clip, I do want to say, I think I can definitively say now we actually do have a above average level of uncertainty. I mean, if this isn't it, what is it? I don't know.
Jack,
And again, maybe you can say that at any time, but
I am cautiously optimistic in the view that we have an above average level of uncertainty. I am cautiously optimistic. You are correct.
so, I mean, I don't know what to do with that. And it makes it very challenging to, I mean, obviously, I don't know if you have, I've been talking to clients a little bit more in the past couple of weeks than I normally would, because I'm getting some calls in with some panicked reactions to what's going on. But yeah, but she's right about this in general, which is we always think there's an above average level of uncertainty. And I don't even know that it matters, like classifying the level of uncertainty, where it falls on the scale. I don't know that it matters in terms of building any investment strategy, but it is important to just to recognize that people are always going to tell you there's an above average level of uncertainty. The market's always going to climb a wall of worry. And so that's just important to keep in mind, because if you let that uncertainty derail you, it can be a big problem for building an investment strategy.
There's two levels on this. There's the level where I'm going to go out and follow our friends like Jim Carroll and Chris Abdel-Macia and all the guys, Jason Buck, all the people who talk about volatility and volatility harvesting strategies. They're really interesting in this because A, they get excited about volatility instead of scared of volatility. And they also unpack what are more, because even in punctuated periods of where you see spikes like this, they'll tell you what's normal, what's abnormal, what looks broken, what's like, oh, this is a period I'm excited about versus something that actually scares me. So you should have some volatility trading friends, and you should follow them in times like this. It's really helpful, strangely comforting. But the other part of this is every story, and this is a lot of my client conversations, every story we can tell is about tension and resolution. And right now we see a market that's down off its peak. We have all these new reasons for tension, and whatever resolution is coming out of this, and whether or not it has to get worse before it gets better, like that resolution is built on the amount of that tension. So if we have lots of uncertainty, if we have lots of questions, we have to also look at this as a coiled spring for where this goes forward. Might not be easy, might be a coiled spring to the downside first, but if, especially back to what we were saying about if we have rolling recessions, if we have little stuff happen, we've got another clip coming up that teases this out a little bit more. There's a lot of scenarios where we're just loading up lots of little different tension points that could resolve optimistically and positively, and quant value could still suffer through all those positive scenarios.
And to your point about the options, guys, this is why I like recording the OPEX effect with Brent Kachuba.
Oh yeah.
And we're going to do one, it'll be out a couple days before this one. I haven't recorded it yet, but it'll be out a couple days before this episode. But like those guys can actually see, we talk about uncertainty, like those guys can actually see in the data what's going on. They can see, are people buying options? What's going on with volatility? Like I like to look at things from that perspective, like in terms of hard data, in terms of what people are doing, rather than talk about like these ambiguous things of uncertainty. And that type of data, I think, is going to tell us that we are what I said at the beginning, which is we probably are in an above average level of uncertainty right now, but that's a data-driven way to look at it.
Data-driven, and it helps you, and this is what I love about Brent's work, is like it helps you understand it through the snapshot of where it's like, here's where market makers and other people are stressed by where they are in their gamma and their positioning and whatever else. It may not tell you what's going to happen in the long term, but it tells you where those like points of stress are. And that can be a really, really useful reminder where I'm sure with you too, it's like you're reminding clients, it's like, yeah, the market's off, but if you're not selling anything, not why do you care, but like, what do you care about? Like, you don't need it to do anything. The real question is, of the underlying stuff we own, is it still doing the things we want it to do fundamentally, foundationally, all those other bits? We can then look at the clearing function of what the market makers are doing or what the options market is telling us and say like, yeah, this is really messed up right now. Like just step back. If you don't need to sell, really the question is there any room to buy, or is there anything else I can do knowing that I've got this tension in the system that I can potentially take advantage of?
So Liz Ann worked with Martin Zweig, one of the more famous growth investors earlier in her career. And here's her talking about the biggest lessons she learned from him.
I don't know that he would generally call himself a market timer. He called himself in more lingo terms, sort of a tactical asset allocator, but generically he was thought of as a market timer, but he would be the first to admit just how difficult an exercise that is, but really based his work on when to have more or less exposure to different asset classes based on an extraordinary amount of data. It wasn't, just finger in the sky, gut instinct, wanting to be bombastic and make market calls. It was really based in economic liquidity and investor liquidity and breadth trends. And he was a big believer in the power of sentiment analysis. He was very much in keeping with that old Sir John Templeton line of, bull markets are born on pessimism, they grow in skepticism, they mature in optimism, and they die on euphoria. And I've always loved that expression because it really does highlight the characteristics of a full market cycle with words that have nothing to do with fundamentals and earnings and valuation. It's just pure emotion. So we understood the power of that and really just invented and created a lot of the investor sentiment indicators that many of us use today. He also understood the power of monetary policy. He coined the phrase, don't fight the Fed, but he also understood the power of staying with the trend. The trend is your friend was a phrase that he coined. So I really learned from one of the best, but ironically also learned that market timing is so difficult to do, that I took the lessons I learned in 13 years working for him, but didn't apply it in an attempt to try to short-term market time. He did that particularly well, but again was the first to admit that it's a really hard thing to do.
Yeah, she talked about him being known as a market timer. And I think this is a huge differentiation a lot of people have to make, which is this idea, but the difference between market timing and trend following. Because market timing is to some degree, or trend following is to some degree market timing, but it is systematic and disciplined market timing. And that's the type of stuff Zweig did. She said the word data a lot in that clip. And that's what Zweig did. And that's the big difference is if you're just throwing stuff up in the air and being like, oh, I'm panicked as I've gotten a couple of calls this week, I want to sell everything. That is a bad form of market timing for the most part. And now it can work out, you can do that and then the market can go a lot lower and you'll probably give it up anyway when you try to figure out when to get back in. But that type of market timing is usually bad. But this disciplined market timing that is using trends can be something that can add value to a portfolio. I mean, if you look at trend following over time, and this is not exactly what Zweig did, but if you look at trend following over time, it produces similar returns to the S&P with less risk. So that actually is a good thing when used properly in a portfolio. So I just think that differentiation is really important.
Not only is that differentiation important, I think it expands out more broadly too. Because when she's talking about watching Marty do this, and I love the way that you broke out the trend following aspect of it, she's watching him do this and basically saying, if we're advising on a fixed amount of capital with this structure, here's ways we can basically protect on the downside, maximize on the upside. For individuals where it's not just a fixed load of capital, like it might be your 401k or your IRA or something where money's not really coming in or out, but off the grand scheme of our lives, like money is always coming in or out. Depending on what phase of life we're in, that money is coming in and out. And we can actually think about it as like, okay, what's the long-term assets that this volatility creates an opportunity for me to allocate to? Like give me, as a 40-something, give me every opportunity for the next however many years to allocate to risk assets that you can give me. I'll take every single one. And if there's a surplus, I'm going to go buy risk assets in those down periods. On the flip side, if I'm spending money or whatever else, I'm looking for safe assets where there's safe haven that aren't bothered by this stuff, a money market, treasuries, short-term bills, something, and going like, okay, just how can I protect my long-term assets and not act here? The very rules of trend following can be applied across assets and across our lives and levels to just go, where's above average risk happening? Where's below average risk happening? And how can I make that suit my needs? It's all market timing. Anytime you buy or sell, it's a version of market timing. Better to embrace this stuff and think intelligently through it like she did.
So this next one is a place where investors get in trouble, but also a place where people like you and me, can't stand what goes on because it causes so many problems for us. But here's Liz Ann talking about benchmarking.
Many investors have, maybe artificially or for whatever reason, have the S&P as their benchmark on the upside. But how quickly does a positive return become the benchmark on the downside? You don't tend to hear a lot of people saying, woohoo, I was only down 15% when the S&P was down 22%. I nailed it. It's, I lost 15%. The other thing that comes into play, I had such a fascinating conversation. It was actually specific to NVIDIA with a client a number of months ago. I was out in the Bay Area, obviously a lot of interest in and ownership of tech and tech-related stocks in that area. And I had a gentleman come up to me after an event at which I spoke, and it was an informal conversation. He was very nice, very lovely. He wasn't critical, but he said, I had a little trouble. My financial consultant at Schwab suggested that I trim 10% of my NVIDIA, and I didn't want to do it. I kind of fought him, and he just talked about the merits of diversification, taking some profits. So I trimmed 5% instead of 10%, and then the stock kept going up, and I'm really annoyed. I said, well, you still own 95% of your position. Would you really be happier if the stock cratered? Because you would have the bragging rights of having trimmed it? Like, you should still be happy that the stock is going up, even if you have 5% less. Trying to time these things with precision, both on the buying end and the selling end, is just an impossible exercise. We shouldn't do it, and we shouldn't let it infect our mindset and our emotions. And to his credit, he said, you know what? I never really thought of it that way. You're absolutely right.
Yeah, so Matt, everybody wants this investment strategy she talked about, which is the strategy that beats the S&P 500 on the upside and doesn't lose money on the downside. And I have not found it. I mean, maybe like Renaissance Technologies has it, but I have not found it for them.
This is the equivalent of basically like asking how much you bench, right? It's really a pointless exercise. You can do it, but it's just some kind of awkward status flex at the end of the day. And this is a fairy tale. This is like the perfect benchmark is basically Hans and Franz, right? That's all we got.
But it's also like the problem with this is when it translates into how you act in your portfolio. And so if you're going to react in your portfolio, like I'm fully invested in stocks, and now my benchmark is I want to be above zero. So now during what we're going on right now, I'm selling my stocks. That's a major problem. If I'm in a diversified portfolio and I'm trailing the S&P on the upside and I want to panic and change that, that's a problem. And so as much as this is, this is not obviously, if you talk about it like the way we're talking about it, you realize it's not a sensible thing to be doing. A lot of people do it in the real world, and it leads to problems in terms of changing your asset allocation at the wrong time. And it's really appropriate for what we're dealing with right now, because we're dealing with a lot of volatility and people who have been making money are losing money. And the ability to stick with your strategy during that is really important. And the benchmark's a big part of that.
Chasing is always, always, always dangerous. And if anything, the last, call it 2 months or whatever of the last 2-ish months we've been through since markets have gotten volatile here in the middle of March 2025, effectively now, the things that worked the best for the last 2 years haven't worked so great in the last 2 months or 2 weeks. And if you're just chasing those things, you're trying to optimize around to beat the benchmark, you might have gotten sucker punched in the very, very recent past. And this is where you have to have a longer term, bigger philosophy that you can tack back to. Otherwise, the risk of chasing is very, very real. And you can experience that in these bouts of market volatility, because the problem is you might not be wrong once. You might end up wrong 2 or 3 times in a row. And that's always the biggest risk.
This last part she talked about at the conversation she had with the guy at the event is, I think, one of the hardest things to do as an investment advisor. So she's talking about someone who has a bunch of NVIDIA. Their advisor at Schwab told them to scale it back, which was probably a very smart decision because it was probably a big part of their portfolio. NVIDIA kept going up. They're angry about that. And that to me is one of the biggest no-win situations, because obviously the sensible thing to do if you encounter somebody who has a huge portion of their portfolio in one stock is to trim the stock. But you're putting yourself at risk as an advisor, because if the thing keeps running, even if you sold, I think she was talking about they sold 5% of their position or something, they're still going to be angry, because even though I'm making money on the 95% of the position, I could have been making more if I had the 100. And so you probably deal with this more than me, but that's got to be an incredibly challenging conversation to have and an incredibly difficult decision to make.
I think I try to remind people in this, and this is one of those things that hits too close to home for anybody in our business, because we've all met this person. Many of us work with this person, and you feel bad. You feel bad saying, hey, that thing you're doing that's working really, really well that I'm going to tell you is not smart to be doing, you shouldn't be doing it. And you feel bad when you see it going up and you see all those things, but you have to remind them, whatever you call yourself, an advisor, a wealth planner, a portfolio manager, whatever it is, you have to remind them the thing is, don't understand your position sizing. Don't take more risk than you need to take on this. And more often than not, when we see people with a concentrated position in something, the question is do we need to be taking this risk? Is there anything else you would rather do with this? The greatest thing in the world is when somebody owns something, they've taken a concentrated risk by building a business, or they luck their way into buying a bunch of stock at the right point in time. And you go, instead of rebalancing this and saying, put this in your boring diversified portfolio, that surging NVIDIA stock goes and buys the vacation home, or it does something with some extra purpose in the life. If you don't need to be taking the risk, understand what value it's providing you. And who knows, maybe some of those people just own this stuff, and when it keeps going up, they just want to use it to punch back other investment professionals or whatever else and say, like, look how dumb you are. That's okay too. Like, we're good at this. This is part of our job description, right, Jack? Like, we're supposed to be punching bags for people in frustrated points so that they take it out on us and we have hard conversations that keep them doing something disastrous to themselves over the long term. That's
that's absolutely right. Yeah, and the challenge with this is a lot of times people have to see the thing not working. And so they've seen the thing working for a really long time. And you can say, in theory, we have too much in this. We need to reduce this. But until they see it not working with their own eyes, they don't believe it's not going to work. And that can be like a chicken and egg thing. It's a challenging thing for an advisor because you want to pair it before you have, especially for something that's a very risky investment. Because sometimes when after you've seen it with your own eyes, it's too late. So it's a very challenging thing to do.
Rebalancing is not an oil change. There's not like drive 3,000 miles and then you have to have this done. There's no magic light that comes on. There's no person at the local Valvoline or, garage that's going to say you're fine. But much like the oil change or much like whatever else, if you ignore this stuff, it will eventually turn around and bite you. And it might bite you horribly if you just ignore it altogether. I don't know if you've ever missed an oil change for an extended period of time, but I hear it's very, very bad.
My wife has done that, but I have not done that. But I do like the rebalancing light, by the way. It's like an app Matt could install on his client's computer. Like the rebalancing light just goes on at a certain time, like it's time to do it. If you get people to follow it, it would be fantastic.
Yeah. We'll put some confetti and whatever else. I'll call our good friends who make those apps and see what they say.
So our last one here is our standard closing question we ask everybody, which is if you could teach one lesson to the average investor, what would it be? So here's what Liz Ann said.
I'm often asked, as many strategists are, particularly when there's more weakness in the market or it's a volatile week. Okay, Liz Ann, what are you telling your Schwab investors? Are you telling them to get in or get out? And I have a love-hate relationship with that question. I hate it because I think it's a stupid question, but I love it because I get to explain why I think it's a stupid question. And the real gist of it is neither get in nor get out as an investing strategy. Not even close. It's just gambling on two moments in time. And there's no one that has ever been successful doing that over and over again. And that ties into the second part of this, which is we think it's what we know that matters, meaning what's going to happen in the future, what's the market going to do, whether we're trying to do that on our own or trying to figure out which Yahoo on TV or which strategist is going to have the best market call. It's not what we know that matters, meaning about the future. It's what we do along the way that matters. So those are my on the soapbox views that I think should matter to investors. But we get in the throes of, I need to know what the future holds, and then I can make great investment decisions. Well, it's the unknowable, so don't invest based on it.
Yeah, this goes back. I mean, we've talked about the same idea a lot throughout the discussion here, but this idea of get in or get out, and it's probably the most appropriate time to be talking about that because I've had conversations about this right now. A lot of advisors probably are. The get in, get out thing almost never works. It's not something that is in people's best interest, but they want to know, they want to talk to strategists like her, and they want them to say, all right, it's time to liquidate everything, or it's time to make a huge bet. And that's just not the way things work in the real world.
All in or all out is like neither of which are investment strategies. Like that's just the way it goes. Nobody does this. And the reason nobody does this is because nobody is 100% right and can be right on both of those things. How much in and how much out, or how much risky versus how much risk averse inside of your strategy. That's the actual conversation. It is and always will be about position sizing and exposure and just understanding the expected values of the stuff you're gonna bet on. The greatest thing about where we are here at the beginning of 2025 is that for people who pumped the brakes last year and were frustrated, like they still did really well, but you pumped the brakes last year and you didn't go chasing because you have multiple back-to-back years in a row. It's like, okay, remember that time when we rebalanced a year ago or whatever else, we had some safer assets and then everything still went up? Like, okay, we're now back to, I don't know where we are. We're at like June of last year on like the NASDAQ or something like that. Like we've taken this much time off the map. Big fan of those metaphors too. Here's how much clock we've just erased in this decline. It's like, okay, well, if we rebalance then, are we below the point where you want to buy some of this back now that the opportunity set is starting to look better for your long-term investments? This awareness of position sizing, rebalancing, and again, just make it work for you. Don't be chasing and making it work against you. That's the core of what Liz Ann's trying to teach us here.
And we're going through something like we're going through now. This is the time you're going to see what I would call the aggressive short-term takes on like CNBC and everywhere else. And the people who are telling you to get in or get out, And you're going to be more, I don't know what the psychological reason for it is, but you're going to be more likely to listen to them during a period like this. You're going to be like, I'm already panicked. I went on CNBC. This guy told me the whole thing's going to fall apart. Like it's just more and more important at a time like this to resist that kind of stuff, to not pay attention to that stuff, to maybe not watch CNBC. I don't know. Did they break out the Markets in Turmoil episode yet? I don't think they have.
I don't think I've seen the clip yet. I know I've seen some great like magazine indicators thing for the last like month of where we are with that. You know, our friend Brent Donnelly is always sharing those. Those are always wonderful. Like, yep, top tip.
I mean, it's meaningless from a quant perspective because there's not enough data, but that is like one of the best contrarian indicators of all time. Like the returns in the year after Markets in Turmoil episodes on CNBC is like off the charts. Now, if you look in the data, it's like a lot of the days like occurred one after the other. So it's really the same exact period, like sometimes, but either way, like it's just a good sign for people to look at it that way, because more often than not, like if you get one of these Markets in Turmoil episodes, you're going to look a year from now and be like, I probably should have stayed the course during that instead of panicking.
Yeah. Bespoke had something similar on this the other day too. They do great research and share great stuff about this. And it was basically like, you know, after a decline of this magnitude at this speed, it was like, here's 32 examples from the last however many years. And this is not like a 100-year study. This is like in the last however many years. It was like, we got 30 examples of this, like 32 times, like within 12 months or 6 months or 18 months. I forget what it was. Basically, markets are positive. You fall this fast, most of the time they're positive. The one time when they were like, it's negative, it was off from like 1% from where we are. You have to flip your brain to look at this stuff opportunistically. And to answer your question, it's somewhere between like the recency bias and the availability heuristic. It's the same thing as like when the door blows off the Boeing plane. If you have a flight the next day, it feels like a terrible idea. The short-term takes will occupy way too much space in your brain. So if you let that stuff in, again, it's so important to be skilled at the mental jujitsu to go, the more horrible short-term takes I see, the more I want to train my brain to think like, take the opposite side of this thing because people are betting on the worst of the worst. I anxiously await the Markets in Turmoil episode. And I know we can't tip it and start making our own Markets in Turmoil episodes just to turn markets. That'd be like an unfair advantage, right? A weird cheat code.
I might turn the Brent one into one just as a joke. I might like flash a little thing at the beginning. But hopefully we can be like, yeah, that's what I'm hoping we can do, is maybe put this stuff like in a long-term perspective. We actually got a comment, and I'll close out on this, but we got a comment recently on one of our episodes that you guys are the furthest thing from finfluencers I've ever seen, which is probably the best compliment we could possibly receive.
Absolutely. I love that. That means my recession indicator is working. I know everything is good. If we're not finfluencers, we've won by all measures of my imagination, Jack.
And that's probably a good point to wrap up on. Thank you, everybody, for joining us, and we'll see you next time.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on YouTube or your favorite podcast platform, or leave a review or a comment. We appreciate it.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the participants or their clients.